Hello viewers, welcome to my channel. I am Hasham. Presently, I am giving the lectures on the topic marginal costing. So many problems we have solved, 27 problems, up to 27 problems we have completed on marginal costing. So hope my regular viewers have already watched all the previous videos, got a good command on this topic of marginal costing. It's a very important topic in managerial accounting or management accounting. Sometimes in some universities it will be called as management accounting, in other universities it will be called as managerial accounting, but the meaning is same, the techniques are same. So under managerial accounting, the most important technique used by management for decision making purpose is marginal costing technique, right? So in the previous video, first video, I have given the complete explanation, the introduction of managerial accounting, marginal costing. So if you watch that video, definitely you can get the concept of what is marginal costing technique, absorption costing, marginal costing, what are the differences, why this marginal costing is more important than absorption costing, what is break-even analysis, CVP analysis, and what are the different formulas I have explained in the first video. So if you have not watched the first video, I suggest you to go to the playlist, select the subject managerial accounting. In that managerial accounting, you'll find the topic marginal costing. Select the video on introduction theory. Watch the complete video, get the confidence regarding the concept of marginal costing, then we come to the problem. Then only you can be able to understand. For the new viewers, first time who joined my channel, I suggest you to visit the playlist of my channel. I have uploaded a number of videos on different subjects, different topics: financial accounting, advanced accounting, cost accounting, corporate accounting, business statistics, financial management, investment management. So many videos I have uploaded. Select your subject, select the topic, watch the video, increase your knowledge. Now I am starting the next problem, that is problem number 28. But before starting the problem, I expect my viewers to have a printout of the problems. I have given all the problems in the link under my description. So go to the link in the description, take a printout and keep it ready before starting the problem. Now I am reading out the next problem, problem number 28. See the 28th problem. A company's turnover means sales. A company's turnover in 1989 is rupees 3.20 crore. 3.20 crore. Its contribution margin ratio is 0.4. Contribution margin ratio is nothing but PV ratio. PV ratio को ही contribution margin ratio कहते हैं. तो PV ratio is 0.4 and fixed cost was rupees 80 lakh. This was in the year 1989. So three items are given in 1989. What are the three items? In 1989, sales are 3.20 crore. PV ratio is 0.4 and fixed cost is 80 lakh. This is the information given for 1989. Now what will be the company's profit in 1990? Now in 1990, how much is the profit? This is what we have to find out. If sales were 3.80 crore, in 1990 sales are 3.80 crore. Assuming that fixed cost will rise by 10%. In 1990 it is expected that fixed cost will increase by 10%. What was the last year fixed cost? 80 lakh. In this 80 lakh, 10% will be the increase. So fixed cost increase by 10%. New fixed cost 80 lakh plus 10%, 88 lakhs. Now in 1990, the total fixed cost will be 88 lakhs. And we have to find out what is the profit in 1990. So first of all, PV ratio. By using PV ratio, we will calculate the contribution. By using PV ratio, we calculate the contribution. The PV ratio is equal to C by S. What is the PV ratio last year? 0.4. So we assume PV ratio will remain same because there is no change in variable cost. Variable cost and selling price per unit are remaining same. So C by S. So 0.4, PV ratio is 0.4, contribution we have to find out, and sales are given in the problem 3.80 crore. 3.8 crore is the sale in 1990. So in place of S, 3.8. Now cross multiply, C is equal to 0.4 into 3.8. You will get 1.52 crore. So what is this contribution? contribution is 1 crore 52 lakh. 1.52 crore. It means 1 crore 52 lakhs. So contribution 1 crore 52 lakhs. From this we subtract the fixed cost. What is the new fixed cost? 88 lakhs. The current year fixed cost is 88 lakh. So 1 crore 52 lakh minus 88 lakh, 64 lakh rupees is the profit in the year 1990. That's what it is asking. What is the profit in 1990? So you have to remember, first we calculate the contribution. From contribution, deduct the fixed cost. We'll get the profit. That's it. This is the end of problem number 28. Now 29th problem. From the following data, calculate PV ratio, profit when sales are 20,000 and new break-even point if selling price is reduced by 10%. The fixed expenses are given 4,000 and break-even point is given 10,000. Now see here. Fixed cost 4,000, break-even point 10,000. This is what it is given. Now we have to calculate PV ratio. PV ratio formula, by using the BEP formula we calculate PV ratio. The formula for BEP, fixed cost by PV ratio. BEP is given in the problem 10,000. So in place of BEP I am writing 10,000. Fixed cost is given in the problem 4,000. PV ratio we don't know. So denominator PV ratio. Now we'll make a cross multiplication. 10,000 into PV is 10,000 PV. 4,000 into 1, 4,000. So 10,000 PV is equal to 4,000. PV is equal to 10,000, 4,000 divided by 10,000. Here it is multiplication, so it will become division. So 4,000 by 10,000, 0.4. So PV ratio is 40% or 0.4. One answer we have completed. We have calculated PV ratio. Second, what is the profit when sales are 20,000? Profit is equal to how much when sales are 20,000? We use the PV ratio formula. PV ratio is equal to C by S. PV ratio 0.4 already we have calculated. In place of C I am writing F plus P. There are two formulas for C. We can take S minus V or we can take F plus P. We require profit. That's why I am writing F plus P. Profit चाहिए, इसीलिए मैं दे रहा हूँ F plus P by S. So 0.4 is equal to fixed cost. How much is the fixed cost here? 4,000. Profit we have to find out. And how much are the sales? Here sales are 20,000. Now cross multiply. 4,000 plus P is equal to 0.4 into 20,000, 8,000. So 4,000 plus P is equal to 8,000. P is equal to 8,000. This plus 4,000, here it will become minus 4,000. The profit is 4,000. Second question completed. Now third point. New break-even point if the selling price is reduced by 10%. What is the new break-even point? The earlier break-even point is BEP was 10,000. Earlier BEP was 10,000. Now we have to find out what is the new break-even point if the selling price is reduced by 10%. So new BEP how much if selling price is reduced by 10%. What was the old selling price? Not given. We are simply given the PV ratio. PV ratio we got 40% old PV ratio. But when selling price is reduced, the PV ratio will also change. So how much was the old selling price? Not given. So we will make an assumption. We'll make an assumption the old selling price was 100 rupees. Let the old selling price be rupees 100. So PV ratio is equal to C by S. S minus V by S. So PV ratio 0.4. We got 0.4 PV ratio. S minus V. What we have supposed the selling price? 100 rupees. So in place of S I am writing 100 rupees. We don't know what is the variable cost. So S minus V. 100 minus V divided by 100. If I make a cross multiplication, 0.4 into 100 is equal to 100 minus V. So 0.4 into 100 is 40. 40 is equal to 100 minus V. Bring the V to LHS. ये minus V इधर आकर P हो जाए. Is equal to 100 minus 40. So V is equal to 60. Variable cost per unit is equal to 60. In simple words, before change, before the selling price change, the selling price was 100, variable cost was 60. जब 100 rupees selling price है, तो वेरिएबल कॉस्ट 60 रुपीज होगा. वेरिएबल कॉस्ट 60 रुपीज हो गया. नाउ we are decreasing the selling price by 10%. The selling price is reduced by 10%. What was the selling price? Old one 100 rupees. Now 100 rupees में से 10% कम कर देंगे 90 rupees. Now the selling price per unit has been reduced by 10%. तो new selling price 100 minus 10% 90 rupees. तो new PV ratio. तो C by S into 100 S minus V by S. What is the new selling price? 90. There is no change in variable cost. Variable cost was 60 rupees. So 90 minus 60 by 90 into 100, 33.33. 33.33% is the new PV ratio after changing the selling price. Selling price 10% कम कर देने से PV ratio come down to 33.33%. Earlier PV ratio was 40%. Before changing the selling price, the PV ratio was 40%. After changing the selling price, the PV ratio has come down to 33.33%. Now it is asking you what is the new break-even point. New break-even point is equal to fixed cost divided by new PV ratio. The fixed cost is 4,000. 4,000 divided by 0.3333, 12,000 rupees. The new BEP will be 12,000. The old BEP was 10,000. Before change, the BEP was 10,000. After change, the BEP will become 12,000. That's all. So this is the end of problem number 29. Now I am reading out the problem number 30. 30th problem. Company X and company Y sell the same line of product at a unit selling price of 40 rupees. Both the companies, the selling price is same. How much is the selling price? 40 rupees. And the variable cost per unit for each company are 24. तो दोनों कंपनी का सेलिंग प्राइस भी सेम है और दोनों कंपनी का वेरिएबल कॉस्ट भी सेम है. Both companies sell the same product at 40 rupees. Both the company will have the same variable cost of 24. And both the company will have the same fixed cost as rupees 4 lakh. So both the companies selling price same 40 rupees. Both the companies variable cost same 24 rupees. Both the companies fixed cost also same 4 lakh rupees. Company X reduces its price by 10% and company Y increases its variable cost by 10%. Now the company X wants to reduce its selling price by 10%. Earlier selling price was 40 rupees. Now company X wants to reduce the selling price by 10%. 10% of 40 rupees, 4 rupees. So instead of 40 rupees, now they will reduce by 4 rupees, 36 rupees. पहले 40 rupees पर यूनिट बेचते थे कंपनी X. अब कंपनी X अपना सेलिंग प्राइस को 10% कम कर दी. तो 40 रुपीस में से 10% कम कर दो 36 रुपीस. और कंपनी Y increases the variable cost by 10%. Earlier variable cost was 24 rupees. Now it has increased by 10%. 24 rupees में 10% increase कर दिया कंपनी Y. Now it is asking you compute the break-even point before the change in price and cost. What is the BEP before the change in price and cost? We have to find out for both the companies. Then compute the break-even point after the change in price and cost. Then which company must sell greater volume to break even? Which company has to sell greater volume to break even? This is the problem. Now we calculate the BEP before change and after change. Two columns I have prepared, X company, Y company. What is before change? Before change, what is the selling price per unit? 40 rupees, 40 rupees. Before change, what is the variable cost? Variable cost per unit 24, 24. So what is the contribution per unit? Selling price per unit minus variable cost per unit. You will get the contribution per unit. So contribution per unit 16. Total fixed cost 4 lakh, 4 lakh. दोनों कंपनी का सेम. तो BP in units is equal to fixed cost by contribution per unit. Fixed cost is 4 lakh. Contribution per unit 16. So 4 lakh divided by 16, you will get 25,000 units. So both the companies, the BEP in units is 25,000. 25,000 units is the BEP for both the companies before change. If you want in rupees, multiply 25,000 into 40, you will get 10 lakh. 25,000 units into 40 rupees, you will get 10 lakh rupees is the BEP for both the companies. Same before change. Now we are making the change. Company X reduces its price by 10% and company Y increases its variable cost by 10%. Now both the companies are making the changes. So पहले company X selling price per unit. Company X is reducing the selling price by 10%. What was the selling price earlier? 40 rupees. 40 rupees minus 10%, 36 rupees. 40 rupees का 10% 4 rupees. So 40 minus 4, 36. So 36 rupees is the new selling price of X company. X company. Y company selling price has not changed. Y company no change in selling price. What was the old selling price? 40. The new selling price also 40. No change. Now company Y. Now company Y increase its variable cost by 10%. Increase its variable cost by 10%. What was the old variable cost? 24 rupees. तो 24 rupees में 10% increase कर देंगे, बढ़ा देंगे, तो it will become 26.40. तो 26.40 is the variable cost per unit of company Y. तो company Y में 26.40. Company X no change in variable cost. No change in variable cost. How much is the variable cost? 24. 24 remains same. Now subtract. 36 minus 24, 12 rupees is the contribution per unit of company X. Here 40 minus 26.4, 13.6 is the contribution per unit of company Y. Now we can calculate BEP. New BEP. Fixed cost divided by new contribution per unit. This is not BEP in rupees, it is BEP in units. BEP in units. Fixed cost divided by new contribution per unit. The fixed cost is 4 lakh rupees, no change. The fixed cost is same. Divided by contribution per unit, new contribution is 12 rupees. The 4 lakh divided by 12, you will get 33,333.33 units. 33,333.33 units. This is the new break-even point for company X. Company Y. 4 lakh divided by 13.60. 4 lakh divided by 13.60. 29,411.76 units. This is the break-even point in units for company X and company Y after the change. After the change. If you want in rupees, the BEP in rupees is equal to BEP in units into selling price per unit. How many units is the BEP? 33,333.33. What is the new selling price? New selling price is 36. So we multiply 33,333.33 into 36. After multiplying, you will get 12 lakh. So 12 lakh rupees is the BEP in rupees for company X or company Y. How many units? 29,411.76 into what is the selling price? 40. So here 29,411.76 into 40, you will get 11,76,470 rupees. This is the BEP in rupees for company Y. That's all. So it is asking you to calculate the BEP before change and after change. Before change, 10 lakh rupees BEP for both the companies. How 10 lakh? 25,000 units into 40. 25,000 units into 40. 10 lakh rupees was the BEP before change. And after change, the BEP is 12 lakh rupees for X company and 11,76,470 for the Y company. Last question it is asking you, which company has to sell greater volume to attain BEP? Which company has to sell greater volume to attain BEP? Company X. Because company X will attain BEP at 12 lakh. Whereas company Y will attain BEP at 11,76,000 only. So company X has to sell greater volume, more units it has to sell to attain the BEP. So here company X has to sell greater volume to attain the BEP. That's all. This is the end of problem number 30. Now we start the next problem, problem number 31. See the 31st problem. Two competing companies, P Limited and Q Limited, produce and sell the same product in the same market. So two competitors are there, P Limited and Q Limited. They are producing and supplying in the same market. For the year ended 1991, their forecasted profit and loss accounts are as follows. So we are given the forecasted profit and loss for P Limited, Q Limited given in the problem. P Limited, Q Limited. Sales 3 lakh, 3 lakh. For both the companies, the sales are same. Less variable cost. For P Limited, variable cost 2 lakh. For Q Limited, variable cost 2,25,000. The variable costs are different. Then fixed cost. The P Limited fixed cost is 50,000 and Q Limited fixed cost is 25,000. That means the variable cost and fixed cost are different for both the companies. But when we add up fixed cost and variable cost, the total cost 2,50,000, 2,50,000. That means the total cost of P Limited and Q Limited are same. The sales of P Limited, Q Limited are same. So sales minus total cost will get the profit. The profit is 50,000 for P Limited, 50,000 for Q Limited. See, both the companies' total sales are same. Both the companies' total cost is same. Both the companies' profit are same. Then what is the difference? The composition of fixed and variable cost are different. The variable cost and fixed cost for both the companies are different, right? And you are required to calculate PV ratio, BEP and MOS for each business. For P Limited and Q Limited, we have to calculate PV ratio, BEP and MOS. We have to calculate. Second, sales at which each business will earn a profit of 30,000. What is the sales? Sales required to earn a desired profit of 30,000. And third question, explain which company is likely to earn greater profits in the conditions of heavy demand for the product and low demand for the product. The last question, we have to give the explanation. Which company will earn greater profits when the demand is high and when the demand is low? This is the problem. Now, see carefully. Calculation of PV ratio, BEP and MOS. Two columns I have prepared, P Limited, Q Limited. Sales are given 3 lakh P Limited, 3 lakh Q Limited. Less variable cost. Variable costs are different for both the companies. In P Limited, variable cost is 2 lakh, Q Limited 2,25,000. So sales minus variable cost will get the contribution. So 3 lakh minus 2 lakh, 1 lakh contribution, 3 lakh minus 225, 75,000. Contribution was a fixed cost minus fixed cost, 50,000, 25,000. So profit remaining 50,000, 50,000. Right? Now we'll attempt one by one. PV ratio. The formula for PV ratio is C by S into 100. C stands for contribution. Here contribution we have 1 lakh rupees contribution, sales 3 lakh. So 1 lakh by 3 lakh into 100, 33.33% is the PV ratio of P Limited. Q Limited, how much is the contribution? 75,000. Sales 3 lakh. So 75,000 by 3 lakh into 100, 25%. The PV ratio of P Limited 33.33% and Q Limited 25%. Now BEP. BEP fixed cost by PV ratio. The fixed costs are 50,000. 50,000 by 33.333%, 1,50,000. For Q Limited, fixed cost 25,000 divided by 0.25. You will get 1 lakh rupees. So 1,50,000 is the BEP for P Limited and 1 lakh rupees the BEP for Q Limited. Now MOS, margin of safety. Actual sales minus BEP sales. How much are the actual sales? 3 lakh. BEP sales 1,50,000. So 3 lakh minus 1,50,000. 1,50,000. Here 3 lakh minus 1 lakh. 2 lakh rupees is the MOS. The first question we have completed. It is asking you to calculate PV ratio, BEP and MOS for both the companies, P Limited and Q Limited. Second, sales required to earn a desired profit of 30,000. Already you have the formula. Formula number 6. Sales required to earn a desired profit. The fixed cost plus desired profit divided by PV ratio. How much is the fixed cost here? 50,000. How much desired profit? 30,000. So 50,000 plus 30,000 divided by 0.333, 33.33%. You can write 0.333. So 80,000 divided by 0.33, 2,40,000 is the sales required. Similarly, how much is the fixed cost? 25,000. So 25,000 plus 30,000 divided by 0.25, you will get 2,20,000. So 2,40,000 is the sales required to earn a desired profit of 30,000 for company P Limited. For Q Limited, desired profit 30,000 के लिए 2,20,000 is the sales. Over. Now, it is asking you which company will earn greater profits when the demand is heavy. So remember one point. When the demand is increasing in the market, that company is better company whose PV ratio is more, whose profit volume ratio is more. Comparatively, PV ratio is more for P Limited. P Limited PV ratio is 33.33%. Q Limited PV ratio is 25%. So which company is having higher PV ratio? P Limited. So if the demand in the market is increasing, heavy demand, P Limited will earn greater profits because P Limited's PV ratio is more. That is the explanation. Low demand. If in the market the demand is falling, decreasing, declining, in that case, that company will earn greater profits whose PV ratio is less. Whose BEP is less. Whose BEP, break-even point, is less. So now we compare the BEP. The BEP of P Limited is 1,50,000, whereas the BEP of Q Limited is 1 lakh. That means Q Limited will start getting the profit after 1 lakh, whereas P Limited has to wait up to 1,50,000. After rupees 1,50,000, it will get the profit. But here Q Limited will start getting the profit immediately after 1 lakh. So when the demand is falling, decreasing, that company will earn greater profits whose BEP is less. Here the BEP is less for Q Limited. So Q Limited will earn greater profits in case of falling demand. That's all. This is problem number 31. Now see the 32. Problem number 32. The sales turnover and profit of a company during 2 years are as follows. 1991, 1992. 2 years data is given. First time, a new problem. So 1991, 1992, sales are given, profits are given. Sales are 1,50,000 1991 and sales for 1992 is 1,70,000. Profit of 1991 20,000, profit of 1992 25,000. You are required to calculate A, B, C, D, E, F. 6 questions are asked. First question, it is asking you to calculate PV ratio. Second question, BEP, break-even point. Third, sales required to earn a desired profit of 40,000. Fourth, the profit made when sales are 2,50,000. Fifth, margin of safety at a profit of 50,000. Last, variable cost of the 2 periods. We have to calculate the variable cost for 1991 and 1992. That's it. Now, one by one, 32. Year 1991, 1992, sales are given 1,50,000, 170, profits 20, 25. This is what given in the problem. First question, PV ratio. There is a formula for PV ratio, change in profit by change in sales into 100. This formula we have not applied in the earlier problems because this formula will be applied whenever 2 period data is given. 2 period data is given. We are given the data for 1991 and 1992. So PV ratio is equal to change in profit by change in sales into 100. How much is the change in profit? 20,000 to 25,000. 5,000 is the change in profit. Change in sales, 1,50,000 to 1,70,000. 20,000 rupees is the change in sales. So 5,000 change in profit and 20,000 is the change in sales. So 5,000 by 20,000 into 100, 25%. One question completed. 25% is the PV ratio. Secondly, BEP, break-even point. For calculating BEP, we require fixed cost. Without fixed cost, we cannot get the BEP. So first we calculate fixed cost by using PV ratio formula. So PV ratio is equal to C by S is equal to F plus P by S. In place of C, I am writing F plus P. because I need fixed cost. So PV ratio, how much we got? 25%. So 0.25. I am not multiplying by 100. If I multiply by 100, I should take 25. So 0.25 is equal to fixed cost. We don't know. We have to find out. Plus profit. Take the profit of any one of the year. Any one of the year. Two profits we have. We have the profit for 1991. We have the profit for 1992. Take any one first year. 20,000 rupees profit I have taken. Sales for the same year. When we have taken the profit for the first year, take the sales also for the first year. First year sales are 1,50,000. So 20,000 divided by 1,50,000. Now cross multiply. F plus 20,000 is equal to 0.25 into 1,50,000. You will get 37,500. I am making a cross multiplication here. Like this. F plus 20,000 is equal to 0.25 into 1,50,000, 37,500. Now keep F on LHS. Take this 20,000 to RHS. So it will become minus 20,000. So 37,500 minus 20,000 will get 17,500. What is the 17,500 fixed cost? So we got the fixed cost 17,500. Now easily we can find out BEP. So BEP in rupees is equal to fixed cost by PV ratio. Fixed cost how much we got? 17,500. PV ratio how much we got? 0.25. 70,000 rupees is the break even point. Two questions completed. First we have calculated PV ratio, second we have calculated BEP. Third question, sales required to earn a desired profit of rupees 40,000. Sixth formula, sales required to earn a desired profit. Fixed cost plus desired profit divided by PV ratio. Fixed cost plus desired profit by PV ratio. Fixed cost just now we got 17,500. Desired profit 40,000. PV ratio 0.25. 2,30,000 rupees is the sales required to earn a desired profit. Now fourth question, D. Profit is equal to how much when sales are 2,50,000. If sales are 2,50,000, how much would be the profit? We'll make use the formula for PV ratio. Easily we can find out. The PV ratio is equal to C by S. The PV ratio already we got 0.25. In place of C, I am writing F plus P. Why I am taking F plus P? Because I need profit. I require profit. That's why I am taking F plus P by S. So 0.25 is equal to fixed cost. Fixed cost already we have calculated 17,500. Profit. Profit we have to find out. What is the new profit we have to find out? Sales. How much are the sales here? 2,50,000. In place of S, 2,50,000. Now I am making a cross multiplication. 17,500 plus P is equal to 0.25 into 2,50,000, 62,500. Now keep the P on LHS. Take this 17,500 to RHS. So 62,500 minus 17,500, 45,000 rupees is the profit. So when we will get 45,000 profit? When sales are 2,50,000. If sales are 2,50,000, we will get a profit of 45,000. Next, E point. Margin of safety at a profit of 50,000. Agar profit 50,000 hai to how much would be the margin of safety? We have the formula. Profit by PV ratio. Margin of safety is equal to profit by PV ratio. So profit is 50,000. Divided by PV ratio is 0.25. So 2 lakh rupees is the MOS. Next, variable cost for the two periods. Last question, last point. Variable cost for the two periods, 1991 and 1992. So 1991, we'll make use the formula PV ratio. PV ratio is a multiple usage formula. Every case will use PV ratio to find out different items. So PV ratio is equal to C by S. In place of C, I am writing S minus V. Why S minus V? Because I require variable cost. I need variable cost. So 0.25 is equal to sales. How much are the sales for 1991? You can see here. 1991 sales are 1,50,000. So 1,50,000 minus V divided by sales, 1,50,000. Now I am making a cross multiplication. So cross multiplication, 0.25 into 1,50,000. 0.25 into 1,50,000 is equal to 1,50,000 minus V. Right? Now 0.25 into 1,50,000, 37,500. 37,500 is equal to 1,50,000 minus V. Bring the V to LHS. Since minus V will become plus V is equal to 1,50,000. This plus will become minus 37,500. So V is equal to 1,12,500. V is equal to 1,12,500. What is V? Variable cost. The variable cost for 1991, 1,12,500. Similarly, we have to calculate the variable cost for 1992. Same method. PV ratio C by S, S minus V by S, 0.25 is equal to sales. How much is the sales for 1992? 1,70,000. So 1,70,000 minus V divided by 1,70,000. Cross multiply. So 0.25 into 1,70,000 is equal to 1,70,000 minus V. So multiply 0.25 into 1,70,000, 42,500 is equal to 1,70,000 minus V. Now bring the V to LHS. 1,70,000 minus 42,500, 1,27,500. The variable cost for 1992 is 1,27,500. That's all. This is the problem number 32. So far we have completed 32 problems, and almost every problem you have seen, it's a different, peculiar problem. So I told you already, two things are required to get a complete command. The first thing is watch the video, see the solution of the problem, see the explanation with full concentration. Secondly, practice the problem yourself independently without seeing the solution. Try to solve it yourself. Then only you can get a good command on this topic. So if you're satisfied with my lecture, give a like to the video, share it in your group, and give your comments, give your messages. And lastly, subscribe if you have not yet subscribed my channel. We'll continue the next problem in the next video.